Hello and welcome to today's program titled Supply Chain Finance Programs, a COVID-19 Working Capital Solution. At this time, all participants are in a listen-only mode. For those of you who are logged into the web presentation, you are encouraged to submit questions throughout the conference by typing them into the text box on your screen. For those interested in obtaining CLE credits for this webinar, an attendance verification code will be read during the presentation that will be required on CLE attendance affirmation forms. Please write this code down. It will not be reread, and it is required for CLE credit. Copies of the webinar recording and materials will be distributed to attendees in the days following the webinar. At this time, I would like to turn it over to Paul Kruger. Paul, you may begin.
Thank you very much, Phil. I'd like to welcome everyone to this webinar, this continuing series of COVID-19 focused webinars that Seyfarth is putting forward. First of all, I'd like to sort of say thank you for joining us. Hope you and your family are all well. And today I'm going to be talking through issues, both existing issues and looking forward issues in relation to supply chain finance programs, and in particular how they might provide a COVID-19 working capital solution. I'd welcome questions throughout the presentation. I'll try and answer some of them as we go. Otherwise, there'll be plenty of time at the end for Q&A. So the presentation today is going to be broken up into three separate parts. First of all, I'm going to have a few slides providing an overview, background on what these programs look like, the pre-COVID, post-COVID, summary of issues in relation to what's driving these programs at the moment. I'm going to spend the second part of the presentation on structures and go through a common supply chain finance program structure, the parties involved, the documentation involved, documentation and transaction issues involved, and then I'm going to shift into probably the more interesting part of the presentation, which is current issues, touching on things such as accounting policy, recent moves by the SEC to examine these programs in more detail, and then also look at how I think anyway these programs might be part of the ability to deliver a COVID-19 working capital solution to companies, buyers and suppliers. So, by way of background, and I'm sure all the people on this webinar will know this well, trade finance, as we know it, over the last 10 years, 20 years, and in fact over the last few years, has undergone a period of rapid innovation and change. Gone are the days of rooms full of, back office people filling out invoices or sending invoices, hard copy of invoices. That has practically disappeared, and what we're looking at now is really e-invoicing driving accounts payable departments across pretty well every company that you look at. Now, one of the benefits of this AP automation is it enables companies to generate a tremendous amount of data on their supply chains. Everything from the basic levels of granularity for things such as delinquencies, defaults, the working capital tied up in supply chains, the credit risk against individual suppliers and buyers. And, these managing supply chains and managing the supply chain finance programs has really become an incredibly important working capital focus for both buyers and suppliers. Now, these programs go by a number of different names. Some call them structured trade payables. They're known as reverse factoring, vendor payable programs, and the term that I'll use more often than not today, which is supply chain financing. Now, they're conceptually very simple. Basically, buyers use these programs to extend payables terms. So, for example, a buyer that used to operate on a payables basis of 30, 60 days may stretch that out to 180 days or more. And suppliers, on the other hand, have the option of converting receivables to cash on an accelerated basis. So by way of a very simple example, a buyer may turn around to a supplier and say, we're now going to pay you on a 180-day basis, but don't worry, supplier, we've put in place this program, and you have the option of converting that 180-day receivable into cash on an accelerated basis. But the reality of these programs is that there's very little standardized approach in relation to structures and documentation, and there's also significantly different risks that attach to these programs and significantly different US GAAP treatment issues that apply to these programs as well. But the reality is that they remain, and they are, a very powerful buyer tool to support supply chains and manage working capital. I just want to touch on one point right now, and that is the ability of a buyer to support its supply chain is of pretty significant importance right now, with buyers looking to help suppliers out through these programs, helping them to maintain or stay in business, and help them to have the supply chain there as and when the economies around the world open up. So I'd just like to spend a bit of time looking through the pre-COVID-19 position. And in particular, I'd like to look back at the global financial crisis in 2008 and 2009. Losses on trade finance portfolios have historically been very, very low. Given their short-term nature, the 30, 60, 90-day receivable, banks have been able to quickly reduce their exposure in times of stress. During the global financial crisis in 08 through 11, default rates on these transactions were around about 0.02%. Average loss rates were 0.01%. So some of the safest assets that banks had on their balance sheet during that period. Now, one of the reasons why the default rates and delinquency rates and loss rates were so low is that the fundamental premise that working capital requirements are the lifeblood of a company's existence. In other words, if a company can't fund its working capital requirements to buy raw product to put into a production cycle to manufacture goods, then that really represented the end of the company's existence. And so the credit story on these assets were extremely good. Extremely good. To give you an idea of volume and size, 2014 regional merchandise trade flows, international and domestic, exceeded $18.5 trillion according to some of the trade bodies around the world. And trade finance supported 1/3 of this total, around about $6 trillion. So in anyone's books, that's a massive amount of financing and a massive amount of trade flows. As I said before, they're a very attractive asset class for financial institutions, and we've seen more and more private equity investors moving into this market, creating their own programs outside of banks. And now we look at supply chain finance programs, and we see that they're being widely used in the consumer packaged goods area, telecommunications, chemicals, retail, and aerospace sectors. And at any given time, there's hundreds of billions of receivables financed at any time. Now, just say, picking up on a few of these industry sectors that I've identified, you look at telecommunications, for example. If you're in the business of for example, providing cable services to customers, the trade transaction that exists there is that you're paying a number of installers around the country to take your cable boxes and put them into houses around the US. You're obviously going to be paying those service providers, and that's a classic trade transaction or transaction that could be the subject of a supply chain finance program. The payment that the cable service provider owes to the installer can easily and readily be put through one of these programs. Looking at the aerospace sector, you're the manufacturer of landing gear or avionics, and you're supplying that to a Boeing or an Airbus. Once again, that's a classic trade transaction where Airbus or Boeing owes the manufacturer of the landing gear or the avionics, and often you'll find that those kinds of transactions go through supply chain finance programs. So, looking at the post-COVID-19 position, the World Trade Organization has forecast that world merchandise trade is set to plummet by between 13% and 32% in 2020. They're predicting a recovery in 2021, but the reality is that nearly all regions are suffering double-digit declines in trade volumes as against 2019. The World Trade Organization predicts that trade will likely fall steeper in sectors with complex value chains. In other words, those supply chains that rely on multiple jurisdictions, multiple providers to produce or manufacture. And service trade may be most directly affected as services are, people effectively cut their demand for services. So I guess the big question sitting out there are, how will default rates be affected? Will it be similar to 2008 and 2011? Will supply chains pull back from their globalization trend, which I'll discuss later on in this presentation? And will we see a regionalization or even a localization of supply chains? Another topic that I'll touch later on in this presentation: how are rating agencies, regulators, and investors changing the way that they view supply chain finance programs? There has been a fair amount of discussion amongst rating agencies, accounting policy folks, as to how these programs should be presented on the balance sheets and the cash flow statements of corporates. So moving through to an overall rundown of structures. What I've put together in the next few slides is an overview of how a typical supply chain finance program operates. But first of all, I'd like to step back and say, well, what is a supply chain finance program? And I've attempted to identify it here as a fintech program operated by a bank or non-bank intermediary that A, enables buyers and suppliers to manage and settle trade transactions, and B, enables suppliers to discount buyer receivables. Now, as I mentioned before, suppliers have the option of discounting buyer invoices, and that gives them the ability to mitigate risk. In other words, they don't have too much risk against a particular buyer, with the credit risk shifting to the program operator, and also enables them to raise working capital. Buyers, on the other hand, centrally manage their trade payables. They tend to have one program that looks after the vast majority of their payables. They get a tremendous amount of data that comes out the other side. And they're also able to negotiate better terms with suppliers, and also importantly, support suppliers. So the example I gave earlier on of a buyer extending its payment terms from, say, 30, 60, 90 days through to 180 days obviously has a very good impact on working capital from the buyer's point of view. But the ability of the supplier to discount the receivable provides them or enables them to get their cash up front, obviously at a cost, the discount on the discount on face value. Now, all major domestic and international banks operate these programs, and there is an increasing number of non-bank intermediaries that are now a material part of the market as well. And examples of the non-bank intermediaries are entities such as Orbion, Prime Revenue, Receivables Exchange, Trade Rocket, Thalia, Kariba, Greensill, TradeShift, the list goes on. And a trend that I've seen over the last few years is B2B, business-to-business platforms, payment and e-invoicing platforms are increasingly offering invoice discounting as a module attached to their e-invoicing programs. So in other words, if you started off life as a platform which enabled buyers and suppliers to invoice each other, buyers to manage their payables, suppliers to manage their receivables, we're now seeing a trend where the data that comes from that exchange of information is being used by platform providers to enable suppliers to discount receivables. Now, there's a few significant differences between the programs which are operated and offered by banks and non-banks. And I think the most important differential is that related to committed funding. In other words, if you're a supplier sitting there, do you know that the bank or non-bank program platform is going to enable you to discount receivables on an ongoing basis, or is it purely discretionary on the part of the funding entity? So here's a diagram which describes or portrays how a typical program operates. Now, looking at the parties involved, the bank investor is probably the most important part of this entire program from the point of view of operating the program and also providing the capital to purchase invoices from supplier. Supplier speaks for itself. That's the entity that supplies goods and services to the buyer pursuant to an underlying trade transaction. And the program is the fintech web-based platform that I described before, which enables the collaboration between supplier, buyer, and bank investor. Underpinning all of this is there has to be a trade transaction, which is right at the bottom of the diagram. That's the transaction pursuant to which supplier and buyer agree to sell goods, sell services, an invoice is created, and a payment obligation comes out of that invoice. The transaction involves typically two major documents or main documents: a receivables purchase agreement, pursuant to which the bank investor agrees to buy the receivable from the supplier, and on the other side of the picture is a payment services agreement, where the bank investor agrees to make payments on behalf of the buyer agrees to manage payments that the buyer is due to make to its suppliers, to the invoices which are discounted. So working our way through the diagram, as I said before, underpinning every transaction or every supply chain finance program is a trade transaction. The invoice is uploaded onto the program by supplier, which is step one. Details of the invoice are communicated to buyer. Buyer then approves the invoice for payment through the SCF program, and that approval is communicated to supplier. So at that point in time, the supplier holds on to an approved invoice, in other words, an invoice that the buyer has said, yes, that is good for payment. So the supplier can then elect to either wait for payment until the invoice matures or discount it through the SCF program. The invoice discounting is done by way of a discount request, which is made by supplier through the SCF program, and that is communicated to the bank. The bank investor then agrees to purchase the invoice or decides not to purchase the invoice, and that's communicated to supplier through the program. The purchase of the invoice is governed by the underlying receivables purchase agreement, and all of this takes place in pretty well a nanosecond, with the uploading of the invoice, the approval for payment, and the purchase by the bank. Now, if the bank investor agrees to discount the invoice, it pays the supplier an amount equal to the face amount of the invoice less a discount, step 9. And on the invoice due date, is that 90 days or longer period outstanding, the buyer makes a payment to bank investor as opposed to supplier because the bank investor has purchased the invoice. Payment services are provided to the bank or to the buyer through the payment services agreement. And in the event that the invoice is not settled on its due date, the bank investor looks to the buyer as opposed to the supplier for payment. The bank, however, does also retain some limited rights, which I'll talk about later on, in relation to breaches of non-credit related reps and warranties on the invoice. So looking at the role of buyers, buyers use these programs to centrally manage their trade payables. The bank or non-bank platform often provides a degree of AP automation, often relating to managing payments as opposed to managing invoices, although a lot of these platforms these days do extend to providing e-invoicing and other invoice management systems. In my experience, buyers often use these platforms for a significant portion of their suppliers and payables, and the implementation of these programs is often done in conjunction with extended payment terms. A key issue, I guess, for buyers in these programs is that bank lines are utilized. So if you have a bank, for example, that is operating a program and it is purchasing from suppliers buyer payables, then it follows that that bank is utilizing, or the buyer, more to the point, is utilizing credit lines in relation to a particular buyer, because ultimately they are looking to the buyer for payment under those invoices. Now, when it comes to assignments and participations, in other words, the bank has an asset sitting on its balance sheet. One of the issues that I focus on a lot is to whom that invoice can be on-transferred or on-sold by the bank. I guess as a manufacturing company, the last person that you want to own your receivable and to be able to obtain information in relation to the underlying trade transaction is a competitor or somebody else, an undesirable that would use that commercially sensitive information against you. The payment services agreement itself, it tends to cover all buyers within a corporate group, with a central buyer that acts on behalf of all of those buyers. The buyer and the bank will put together a list of what they consider to be eligible suppliers, which are often entities in jurisdictions that the bank is prepared to work in, particular sizes. Obviously, entities or suppliers that only supply $1,000 or $2,000 a year to a particular buyer are not really appropriate for a program like this. And importantly, under the payment services agreement, the buyer will consent to the transfer and assignment by eligible suppliers of payment obligations to the bank. That is an important part of the documentation, in that the bank will want to be in a position where it has an unconditional claim against the buyer in relation to any supplier invoices that it purchases. The buyer will indemnify the bank in relation to any losses it might suffer as a consequence of an invoice not being paid. And the paying services or payment services agreement will also contain quite detailed provisions in relation to how chargebacks, discounts, allowances, credit notes, and other deductions are applied against payment obligations which have been purchased or not purchased by the bank. Now, in relation to the current position on how these programs are accounted for in the financial statements of buyers, there's very little guidance out there in relation to how these programs impact the cash flow statement and the balance sheet of corporates. What we need to do is look back to two SEC speeches that were made in 2003 and 2004, which provided guidance in relation to how these programs are accounted for on the balance sheet, and in particular, whether they retain their trade debt classification or whether they should be converted into bank debt. And the current position is that unless cross some fairly significant red lines, then the appropriate treatment for buyers is to account for these programs on their balance sheet through the cash flow statements as trade debt obligations. And those red lines I've highlighted on the slide. Things such as, does the program impose a default or cross-default provision on the buyer? Have the suppliers been forced to participate in the platform? Has buyer been involved in the negotiation of documentation with supplier? Is there a three-way agreement in place between buyer, supplier, and the platform provider? How does the program manage credits, rebates, and returns? Is there joint and several liability? The overriding premise or starting point is if you have a separate transaction with the buyer, a separate transaction with the supplier, and those transactions don't overlap, then generally speaking, you can retain a trade type treatment, trade debt type treatment. Now, turning this over and looking at the role of suppliers, as I mentioned before, suppliers use these programs to access working capital without utilizing credit lines. Because ultimately what they're doing is they're taking an asset on their balance sheet, a buyer receivable, and they're converting that into cash by selling it. Now, it's important for suppliers that they achieve US GAAP treatment, in other words, sales treatment. Otherwise, they would likely be in a position where they are putting debt on their balance sheet, secured debt perhaps, as opposed to selling an asset. So the key issues for suppliers are, I guess, quite different than those for buyers, in that they will want to have very limited recourse in relation to the receivables that they've sold. In other words, they will want to know that once they've sold the asset, then provided the asset is of a type that they told the bank it was, in other words, it's owed by X, it's a certain amount, I think basic things like that, basic terms like that, then they will want to wash their hands of the asset and achieve US GAAP sales treatment. I guess what I've found with some of these programs, though, is the level of recourse that is created through documentation often leads to a result where there's indirect or backdoor recourse to suppliers. Suppliers will also need to be convinced that the commercial information that's loaded up onto these platforms is kept confidential. The last thing they want is for a competitor to get hold of copies of invoices or copies of the underlying trade transaction to show quantities sold, price, and so on. And I guess perhaps one of the most significant issues for suppliers is the fact that these programs are uncommitted. In other words, every time a receivable is generated in the platform and offered for sale to the bank or the non-bank, then the bank or non-bank has the ability to decline to purchase the asset. So a supplier may go through a year or two of these programs operating to provide a very nice source of working capital, and then wake up one day and find that that source of working capital is no longer there. Suppliers will also need to be conscious of the provisions of their existing credit agreements, things such as non-disposal covenants, debt restrictions, liens, and so forth. So the guts of a receivables purchase agreement is effectively an agreement on the part of the supplier to sell receivables to the bank or non-bank program operator. There'll be a UCC backup filing to protect the purchaser's interest in the asset, and then there's, generally speaking, a bunch of corporate reps and asset-specific reps, where, for example, the supplier will rep and warrant as to the nature of the assets that is being sold. There's an important distinction to be made between asset-specific reps and general corporate reps in these transactions, in that asset-specific representations should lead to buyback of the receivable. If, for example, to take an extreme example, let's say, for example, that the supplier warranted that the particular receivable was owed by company A when in fact it was owed by company B, then clearly, that's a breach of rep and warranty and should lead to buyback. General corporate reps, on the other hand, in my view, should not lead to a buyback, but should lead more to an indemnity for losses suffered. I have seen in the past transactions structured so that a negotiable instrument replaces the underlying payment obligation. And how that operates is that the parties agree that the obligation to pay X under a trade transaction or receivable is exchanged for a negotiable instrument which has a number of benefits under the UCC. For example, a bank can make a claim against that obligation a lot easier if it's a UCC negotiable instrument as opposed to a trade transaction, and the bank can sell that asset more readily than, say, for example, a trade transaction itself. One of the questions, however, that's automatically brought into play when this happens is, have you fundamentally changed the nature of the trade transaction that exists, such that it's more like a bank debt transaction as opposed to a trade transaction, going back to the SEC speeches in 2003 and 2004. Now, bearing in mind that the multi-jurisdictional nature of most of these programs, I do see quite a difference between the way that, say, for example, documentation is prepared in the UK or Europe versus in the US versus in Asia. Things such as no UCC filing occurs, or no backup security filing occurs in relation to non-US documents. Non-US documents tend to be a lot more straightforward in relation to the recourse back to suppliers and buyers that banks and non-banks expect. So there are some significant differences that are there with the non-US versus US transaction documents and structures. So moving on to current issues. By no means an exhaustive list, but issues that have, some of them anyway, have been floating around now for a few months. Some of them are very recent issues. And standing back and looking at what these programs are, they are uncommitted facilities and they're very much dependent on buyer creditworthiness. If a platform provider decides that they are no longer happy with a particular buyer's creditworthiness, then they will always have the option to stop purchasing or invoices from suppliers. Now, in my experience, suppliers have not been particularly successful in negotiating a return to shortened payment terms. should the supply chain finance program not be available. In other words, if a supplier has agreed to a 180-day payment term against the ability to be able to sell receivables to a program, and that program no longer wants to buy them, then they are stuck with that 180-day terms, and they will have to negotiate or renegotiate payment terms with the buyer. And that may not be a particularly easy thing when the buyer itself may be going through a working capital crunch. So the way I look at it is the supplier is often the entity that carries the immediate financial risk associated with these programs. In other words, they have been running along thinking that they're able to sell these receivables into a program. That stops, and all of a sudden they have to find an alternative source of working capital. The programs themselves, however, have shown to be an important way for buyers to support suppliers, support their supply chain. If you're a Walmart or another major purchaser of goods, one of the ways that you can use these programs is to help suppliers finance their working capital needs. Obviously, indirectly through a financial institution, a non-bank, other program platform provider. But you can turn around and say to suppliers, I'm here to help you stay in business through enabling you to sell my payables, your receivables, to a third-party bank and get your cash up front to enable you to go out and buy the raw goods that you need to be able to produce the stuff that I want to buy from you. The upshot of all of this, though, and I guess the growing importance of these programs is that everyone from rating agencies, accounting firms, and the SEC have subjected these or are subjecting these programs to a significantly heightened level of scrutiny. And as I've said before, in relation to whether or not the right way to treat these programs is trade debt, bank debt. So looking at the three largest rating agencies, they have all issued reports highlighting what they see as the risks attached to supply chain finance. S&P Global recently called supply chain finance a sleeping risk that can mask episodes of financial stress. 2018, probably one of the first rating agencies to come out and subject these programs to heightened scrutiny, they suggested that these programs should be classified as debt. And at the end of last year, Moody's issued a report that highlighted that supply chain finance programs can weaken liquidity at a time of stress, with termination of programs potentially leading to, and I quote, sudden and significant working capital outflow over a matter of weeks or months. But the reality is that underlying every trade transaction or every program is a trade transaction. So I guess the question I'd ask there is, are they suggesting that every single trade debt should be reclassified as bank debt, which would be an extraordinary turn of events? In October of last year, the Big Four accounting firms jointly authored a letter to FASB, and that letter was labeled Disclosure and Cash Flow Statement Presentation of Supplier Finance Programs. In other words, how should these programs be represented in the cash flow and represented in the balance sheet of corporates? Now, they acknowledged that there was no specific US GAAP guidance other than the indirect non-policy guidance provided through the 03 and 04 SEC staff speeches. And they also acknowledged that trade payable treatment may be appropriate if the nature, amount, and timing of the entity's payables does not change. However, they then went on to say in their letter to FASB that the reality is that trade payables classification tends to be a lot more favorable in the calculation of financial ratios and for the purposes of determining compliance or financial covenants. In other words, if you've got a bunch of obligations on your balance sheet that are trade debt in nature as opposed to bank debt in nature, then that's a lot better for you than the flip side, and means that you're far more likely to be complying with your covenants and credit agreements and so on. So the Big Four asked FASB to look at the following potential disclosure items: the nature and terms of the arrangement, the monetary amounts involved, and the amounts due for payables the company understands have been sold. In other words, the amount being put through these programs. And also, and probably the most important element in all of this, is whether or not the amounts that are put through those programs should occur or be represented on the balance sheet and statement of cash flows as bank debt as opposed to trade debt. Now, that's still an open item. Who knows where FASB is going to come out, but this is an incredibly important item for both buyers and suppliers looking to participate in these programs. Now, not to be outdone, the Securities and Exchange Commission also has been looking at this. And every year, the Office of the Investor Advocate prepares a report on its activities during the fiscal year each fiscal year. The report that was produced at the end of 2019 had a paragraph or two, in fact most of a page, devoted to, I quote, reverse factoring's rising popularity and hidden risks. In that report, the SEC highlighted that UBS, for example, had reported that only 34 out of 1,354 companies in its coverage universe disclosed the use of reverse factoring in published documents, in other words, their accounts and so on, and annual reports. But they also suggested that up to 40% use it. The SEC also highlighted that Moody's reported that fewer than 5% of non-financial companies that it rated globally disclosed reverse factoring programs in their financial statements. And PwC survey found that 49% of companies surveyed reported using reverse factoring, and a further 37% were actively considering it. So the SEC is really focused on, and this comes through in their Investor Advocate report, what a company's programs terms are, what portion of the supplier base is utilizing the program, who the capital providers are, in other words, are they global regulated banks versus less well-capitalized fintech companies, and the level of risk on the supplier side. All, I guess, very important issues, and all possibly leading to the SEC saying, well, look, you've got to report these programs in a different way than you are now. And the SEC said in its advocate report that the fundamental issue at the moment is the curtailment of reverse factoring availability represents a liquidity risk which could lead to an immediate and material working capital outflow. I would suggest that that immediate and material working capital outflow is far more of an issue for supplier as opposed to buyer. I'd just like to pause for a minute and give you the CLE code for this presentation. It is SS6101. SS6101. So, where are we now with supply chains in this post-COVID-19 world? One of the lasting impacts of COVID-19 may well be the regionalization or localization of supply chains. And in fact, will we see, and I think we will see, an acceleration of what's already been called a deglobalization of supply chains. Now, you look at what France has done or said recently, and they have directed French companies to reevaluate their supply chain to become less dependent on China and Asian countries. There's been recent discussion in the White House in relation to whether or not U.S. companies or the U.S. supply chain should be redirected towards U.S. manufacturers. And they've openly said, are there critical technologies, resources, and manufacturing that must either stay in country or be moved back in country? You only have to look at the tremendous demand for medical equipment and medical supplies, much of which is coming from outside of the US, to say, well, wouldn't it make sense to try and encourage manufacturers to build facilities and build plants here in the US to protect against or to enable supplies to be readily obtained when supply chains aren't working efficiently. But you look at the reality of that, and that is going to require a significant amount of capital outlay as domestic manufacturing facilities are built. Are there sufficient resources to do that, sufficient know-how? And who's going to bear the cost of building inherently unprofitable facilities? And what I mean by that is if manufacturing facilities moved offshore to start with, often there's an economic reason for that, and that is the manufacturers offshore can produce goods at a far less price or lower price than what they do here. And any localization is also going to require a real uptick in working capital on the part of both domestic buyers and suppliers. You're a supplier, you set up a manufacturing facility here in the US, you've not only got the capital outlay to build the plant, but you're going to have significant working capital requirements as you go out and buy the raw product that's needed to turn your factory and make the product that buyers are going to be buying. And all of this cannot happen overnight. It's going to take months and years to bring into play. So where might we get to with for example, the CARES Act? If I look and step back and look at the way that supply chain finance programs operate, they're a significant part of the supply chain. They touch many different sectors, as I said before: consumer packaged goods, telecommunications, chemicals, retail, aerospace, you name it. They're incredibly efficient. They've operated for a number of years now, and I think most importantly, what they do is they enable companies at what I call the front end of the economy to obtain the working capital that they need to produce goods, to provide services. You look at the restaurant industry, for example. Restaurants go out and they buy produce. To enable them to start, open up again, then they will need a lot of working capital to be able to go out to buy the stuff that they need to turn into food that we eat. All of the major domestic and international banks operate these programs. And I'm of the view that they provide a ready-made vehicle for CARES Act and other financial aid to be delivered to the front line of the economy. And I actually think that they, if they're looked at in the proper way, will provide a very efficient and useful tool to help kickstart the economy when we open up again in hopefully days from now. Right. Well, that concludes the presentation. The slides will be available to all participants, and I guess if there's any questions, I'll open it up to questions.
We do have several questions that have come in. I don't know if you've had much of a chance to look through them, but we can go through some of these questions now if you like. The first one, Stanley is asking, can you give some examples of the transactions in the industries that you identified? Now, this was fairly early on in your presentation. Any thoughts?
Yeah, thanks, Bill. Yeah, look, I think I gave some examples of, the telecommunications or the cable equipment provider that looks to multiple installers around the country. They obviously got to pay those installers on a unit-by-unit basis, and that is a classic asset which can be used to put into these programs. Actually, I can see some of the questions coming through now. Thanks, Phil. Reverse factoring. What is reverse factoring? Well, it's just another name for supply chain finance programs or platforms, in that a typical factoring transaction involves the supplier selling its receivable to a third party. Whereas with reverse factoring, what you're doing is you're looking at a buyer enabling their payables to be sold by suppliers as part of an overall program. I've got a question here. Does using a platform independent of the bank create additional risk? I guess a platform independent of a bank, I guess if I understand the question correctly, a program independent of a bank is dependent on the ability of a non-bank operator to finance receivables on a consistent, ongoing basis. These programs are uncommitted. In other words, a bank will decide whether to fund or not. And one would hope that those funding decisions are based purely on credit as opposed to the ability of the bank or non-bank to raise funds. I hope that answers that question. Some of the other questions?
Another one had come in from Melissa, who's asking, does using a platform independent of the bank create any additional risk? She's saying that our company does have an existing platform that it uses for the payment of suppliers, but it's not owned by the bank. Any thoughts on that?
Yeah, I think I may have just answered that one, Phil, but just to reiterate, the issue with non-bank platforms is the consistency or the ability of the non-bank platform to fund the purchase of receivables. If you've got a non-bank platform and there are substantial either equity or debt providers behind that program, then that's not going to be an issue. The problem will arise, however, where the source of funding to that non-bank platform, turns off, as may be the case now, in which case you have suppliers who are not able to put their receivables into the program and obtain working capital.
Right. It looks like the final question from Andrew, who's asking, are there differences in the way that New York law, for example, and foreign law, say UK law, transactions are documented? Anything there? The main difference, I guess, is the relatively straightforward nature of UK law versus US law documents. With US documents, you always have, or New York law documents, you always have a backup filing that's made with the UCC. With UK law documents, you don't have that. Right, this question has just come in. Razi's asking, if a supplier declines to accept goods that meet the sale and purchase conditions of such goods, does the buyer have an obligation to pay the supplier? What do you think of that?
Razi, I guess in response to that, if a supplier declines to accept the goods, I suppose actually more to the point, if a buyer declines to accept the goods, in other words, supplier sends a whole bunch of goods to buyer says, no, I'm not going to take those, they're not of the right quality, they're not of the right quantity, so on. What will happen in that case is the buyer will, in the supply chain finance platform, decline to accept payment of the receivable. In other words, it's no longer a confirmed receivable, and it'll be rejected out of the funding platform.
I believe our final question comes in from Lee, who's asking, do you see COVID-19 as a risk to current SCF programs, or is the risk more the potential treatment as debt?
I think it's twofold. I think it is a risk to existing programs, mainly because as the economy has shut down, the credit quality, there is no doubt that the credit quality of some of the buyers has decreased, and that may reduce the appetite that banks and non-banks have to purchase receivables owed by those entities. Looking forward, and this is the dual risk, I guess, issue, will these programs become less attractive to buyers and suppliers if some of the accounting, some of the SEC issues that I've discussed actually come to fruition?
I believe with that we can wrap up our question and answer session. We'd like to thank everyone for some great questions. So Paul, back to you for final thoughts.
Thanks a lot, Phil. Look, I guess I've covered a lot of material in a relatively short space of time here, and very much encourage people who have got questions to come seek me out outside of the presentation. I'm more than happy to answer questions that people have. And anyway, with that, stay safe, and I look forward to talking to you further.
This concludes today's webinar. Thank you all for attending. Have a great day.